25 opening salvo. Blake, it's like opening a Christmas present, the first trading day. What leads, what lags? No Santa in 2024. What about the January effect? Biggest risks of 2025 sectors to watch for this year and Bulls and Bears. So Blake,
Yeah.
any New Year t-shirts or is it,
Oh no, I
have we
don't
run
have New
dry?
Year's t-shirt. We go through the holidays and then I don't have anything. Uh, I mean, if we're gonna do the t-shirt thing, we'll have to figure out a different holiday. Maybe we'll do it for Arbor Day. Maybe.
May the fourth be with you. I don't know. Maybe we
Yeah,
got some, we'll
I do
figure out
have one of
something.
those.
He
I have
does
a May
got
the
one.
4th.
So,
Yeah, yeah, yeah.
but anyway, so Blake, I mean, do you have any particular outlook for the market in 2025 or what do you think?
Well, as January goes, the year goes, we've talked about that, the January effect. We're going to get to that in a minute. But my question to start for everybody is, did yesterday surprise you? Did yesterday's move surprise
Ooh.
you in how the market behaved? I mean, it was a wild ride. I mean, I trade futures, as many of you know, and do some intraday trading. We normally are dealing with, on my charts, 15, 20 point ATRs. So we're talking about 20-point moves, and the 1600 ticks will move 20 points. We were dealing with 50, 16, 80 points yesterday,
Hmm.
and without really netting out anything significant. So did that surprise any of you? Did that surprise you, Brandon? Did the market's behavior surprise you yesterday?
Not really. My
No.
perspective is we're still not at a low yet. So I'm looking at forward volatility expectations, and we just have not reached a point. So I'll just show you here, VAX 3M plus VIX. What am I watching for here? I'm watching for a washout day. I'm watching for this yellow line to get below one, meaning that the VIX is higher than the 3-month VIX. So yes, we're saying, look, the VIX still has room to move to the upside before we find a low here. Now, ES futures overnight are seeing a little bit of lift right now. We're still well within the range. Again, I got to see a washout day. We just haven't seen it yet.
What's it going to take? What do you think it's going to be? What's the catalyst? What's going to be pushing it this lower where people will start actually start stopping, stop. When are they going to stop buying the dip? You say a washout day. Where do they give up? And when did they join our merry band of thieves?
Well, based on kind of the way I look at volatility, we were pricing in a 5 to 10% correction here. We got a 5% correction, right?
Mhm.
4.88%. We priced in another 5% correct, 5 to 10% correction here, and we're not there yet. So
Right.
where do we start to find it? Again, 5 to 10% off the high, which means what? Could we get down to 5,600?
Hmm.
That would give you almost 10%, 5,500. And so, from my standpoint, yes, I can throw out values, but what I want to look at is volatility expectations. And so, when I look at this is what I'm watching for, waiting to see this go below one. Now, down in this area, there is risk because you also risk the probability of a 20% move in the market. That those happen rarely. So this is the point where you start to look at getting more constructive in the near term. That's exactly what happened here on the 18th. Then we hit the other extreme on the 24th. Now we're waiting for the other extreme to mark a bottom. And so that's what I'm waiting for. Bigger picture, I got to see skew come down for me to really feel constructive on the market. Just, hey, we want the upside. We're reducing our hedges. That has not happened yet. Skew right now, still just barely off record. We did drop to 157 yesterday. I really want to see this come off hard, and that opens up the big move to the upside if that's about to happen.
Yeah, so I'm with you. We've got to break free from this. It's an ugly looking head and shoulders on top of that if you want to go from a simplistic pattern, and it's slightly sloped down, so it kind of disrupts it. But
Hmm.
whether you want to call it a head and shoulders or not, all we have to do is clear that low to create a full set of very wide swinging lower highs and lower lows. And so even if you don't want to call it a price pattern, just simply create that lower high, which we have. All we have to do is break through that low. And
Yeah.
like you said, 5,600 is the easy target in my mind. And from a distribution model, I think we could go all the way down to 5,400. And what we talked about with the dollar's move and the dollar's strength, that's setting up for that move as well. The
Yeah.
flight to safety is in place. And
Yeah, go ahead.
good. No, I just
I was looking at this rising wedge breakout retest. I mean, really, the potential is 5,100. Now that's a big move down. Now we're talking, again, a little bit more than 10%.
Mhm.
But again, I'm watching the vol markets to see, okay, when are we finding constructive short-term low? And then where do we go from there? Right here, we got a bounce and a lower high. So we didn't take it out. We formed a lower high, and as Blake, like we're looking here again, you start to break levels. Now there's been some significant prints recently in the SPY. And as you break these levels, again, we saw it break here, for example, a couple of huge prints here. We held below it. So this 587 area is pretty significant technically. 3.3 million print, 2.2 million print there, 2.5 million print. So big prints in this area. It's a lot of headwinds in that kind of 587 to 591 area. So the more we wait below we threaten breaking the intraday low of the 20th, and that's where we start to test much lower levels. But so let's take a look at the perspective here for 2025, and it's kind of easy to do. Just go to the trade tab in here. We'll just look at the January's expiration for 2026, or you could go 31 December, and we're looking on. Look at SPY. I'm gonna go SPX. And as we look at these expectations, the scroll down here, December 31, right? We're looking at 944 points. That's the one standard deviation range. 944 above, 944 below. Only that there is skew, which does emphasize the downside and de-emphasizes the upside just a little bit here. But 900 points above 5,800, and we're looking at about what add that number about 6,900 to the upside, and then 944 to the downside. So we're now just below 5,000.
Yeah, and that I think when you look at that, I guess the first question I would have is what would it take for it to go that 900 and some odd points up? What would it take to reach that kind of level? Do we have the momentum? Do we have the economy?
Yeah. My
And
perspective, we gotta
I
have
was just
weak
gonna say
dollar.
that. Yep,
I mean,
you've got to destroy the dollar.
right. I mean, is it possible that, here is a Trump admin coming in? Is he for a strong dollar? Not really. Okay. We always want to talk, oh, king dollar, da 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 da. Oh, I want the dollars. If you want the dollars a reserve currency, you want a weak dollar, right? That means we're borrowing for the world. We're seeing massive trade deficits. So again, you can't have a weak dollar and have a strong manufacturing base. But to improve on the manufacturing side of it, that's not going to happen tomorrow. It's going to take a while.
Yeah, and we can go back and say, well, what about oil? Could it be on the back of oil? Because then we have a stronger dollar and we get back into fracking and being an exporting country. I think that is one of the things that could happen that would drive equities higher. The dollar could remain strong and we could see some more positive net exports, well, less negative net exports.
Our trade
But
balance gets a little bit better in the energy
yeah,
space. But then you're
yeah,
also
and
destroying the petrodollar, right? If we're going
yes,
to export oil, petrodollar's done. And so again, there's we always want to talk at both sides of the mouth. We want to try to appease everyone, but
yes, we
that
do.
is an interesting thing. Energy could save the earnings where it's been at a drag recently in recent years. But here is our one standard deviation range. And I think the downside's easy to achieve, right? That's
Yeah.
Yeah. So we don't need a catalyst to go down. We just haven't gone down enough for a really, really long time. Um, Now, again, we might touch both by the end of the year. What's your odds on that?
Next to zero.
So we might go here and then go boom there.
Yeah,
Yeah.
and
So probably the
I just don't think
touching's
if we were
about
somewhere in the middle
30%,
anyway, we
maybe.
could. Yeah. And as far as our distribution models, we are dead center. We started the year out, I like the TPO or monkey bar charts. And so we started out the year right near fair price from the previous year's projections. So I think we have statistically, we really could. I just don't think economically, I don't think the way the market has behaved, I don't think valuation wise that we're anywhere close to being able to hit both sides. It's just going to be, frankly, the downside.
Yeah. I mean, I think we again for the productivity. I mean, cash summit, love to see it near 2010 lows. That's pretty optimistic in a very negative sense. But 2010 lows are down here at the auspicious 2009 was 666, but 2010 lows in here about 1,000. I don't think that's likely, but man, we could see a decent correction here this year because we'll talk about some of the risks. But the expected move for the market right now is again we got about a 900 point range. And so, yeah, we can have bearish expectations, but again, this is something that we're looking for confirmation. So, from my perspective, projections don't necessarily matter. It's about risk. Risk is the downside right now, and you just have to acknowledge it, but you also recognize when things are bullish. So,
Well,
one of the
$900
things,
gives you 15%, and that's a very acceptable, manageable
Mhm,
pullback.
yeah. So, opening salvo, I love looking at the very first trading day of the year. It's like a Christmas present. You got to open it up. What do we get? Not a lot of big
Stocks.
revelations yesterday in the options market that I saw. But if we look at performance, I changed my 1 week to 1 day. Gold was the best performer yesterday, followed by energy, utilities. Those were my three things that I was watching for the new year. So I was excited to see those three lead out. Again, my first kind of opening for 2025 was looking for gold, energy, utilities. And gold led out yesterday. S&P was down 0.25%, basically saying, look, I mean, this was the dollar was weak yesterday, gold was up. Market did not do well even in the midst of a weaker dollar intrinsically.
The only thing I would counter you on there is when the dollar was weaker, it was the strongest of the main currencies. So
Yeah.
gold was way up
Relative
here.
strength.
I'm
Yep.
off of the chart. I have my arms out of the screen. Gold is way up here. Dollar was here, and then all the other currencies were stacked below it. So the dollar gained as everything else was. All the other currencies were falling, but gold just crushed everybody.
And for me, that is a very I got a month on here. That is a very bearish result,
Hmm.
right? So when you see strong relative strength in the dollar and a weak dollar intrinsically, gold going up. So gold and the dollar relative strength going up. To me, that's a bearish indication of the market. Dollar's backing off a little bit here. We got some data going on today too. But again, you look at ES, we're lifting a little bit off of our lows. We're still well within the range. But again, I like this notion here that again, gold, energy, utilities leading out. We look at gold futures forward / GC. Do we see the continued strength? No, it's actually flattening out a little bit today. A little disappointed. I have not seen really significant option activity in the gold space yet. Normally, gold since 2014, with very few exceptions, have performed very well, bottoming in December, rallying into January, sometimes into February. So I've been looking for gold strength here. But again, yes, it was good, but I still haven't seen a lot of just option activity in the gold space.
And it just tells us that we're not hedging out anything yet,
Yeah.
which we
Jim's mentioning uranium, so energy, DNN. I was on a big move yesterday. It's uranium stock. Yeah, I'm looking for that's all had significant option activity yesterday. CCJ. I am looking at CCJ to rally off the lows here as part of that energy. I forgot to put that on my list. But anyway, so the opening salvo, we kind of see what was kind of leading and lagging yesterday. But the big question I have, and Blake, the January effect. Is January in effect here? The definition is the small caps tend to lead. Now, I'm not going to bank on that, but I am going to look at it. Do small caps lead in January? If so, then it's an if-then statement. That's generally good for the market. If they don't, that's generally not as good for the market.
and
What's
I
your
can tell
thoughts?
you firsthand that I have tried to follow the January effect, and it just has never paid out. It is random at best,
uh,
and at least in my own personal trading, I just don't see it as something that is strong enough that you could lean into anything for any long time frame. You have to have confirmation. You've got to have follow through in the charts. It doesn't it even if you could prove it, it just doesn't give you it doesn't give you enough of an edge that you can really play into it from my personal trading. So I,
and
I
that
I'm
I
just not
totally agree
leaning
with that.
into it. So
Yeah, and so again, from my standpoint, it's like I don't care if small. Again, I'm not banking on small caps leading, but if they don't, that tells me something, right? If we don't see small caps really start to move here, we'll look at some potential reasons why they may or may not. But if they don't, that's a tell sign for the market, right? Small caps are not taking any leadership role right now, especially given how they've underperformed. You look at the last year, for example, Magnificent Seven market cap went from 11.8 trillion to 17 trillion. So I mean, the mega caps have been the performers in the last year plus. Small caps have not. Small caps really didn't overtake their 2021 highs. Um, You brought up this one, ratio of
Mhm.
market cap value to GDP. Blake, what are you seeing here?
So this is also known as the Buffett indicator for those that have heard me talk about this before. And what you're looking at is saying, let's take all the stocks, all the capitalization, the market cap, saying, what are you worth if we take all your open shares and the current price? That's why we get the market cap of the markets. And then we say we compare that to GDP. So what we're saying is that just the publicly traded companies are worth 2 times the rising GDP, which includes government spending. So when we go, not 2 times, two standard deviations out. And so we're seeing that we're at 2.08. And historically speaking, you can see every time it peaks outside of those areas, there's small corrections and big corrections. And we touched it there in the 90s. We touched it there, obviously, in 2000. We touched it there uh, earlier this year and then closed back inside. And that was a pullback, but we're up there at the highs again. And so, how can you sustain the fact that we are trading at valuations at two standard deviations past the entire GDP? That includes government spending, small caps, it includes companies that aren't publicly traded, and just the publicly traded ones are at this level. So the valuations are so far out of whack that there has to be a correction.
Yeah.
And like you talked about with the small cap, is it going to be the small cap that saves the day at those extremes? No.
Yeah, they're not going to save the day, but in the interim, could they pick up a little bit off the lows? We'll talk about the risks here, but Mark have the largest relative to the 75th percentile stock. Again, we're talking about Great Depression levels, right? In terms of the largest stock relative to the 75th percentile stock, there's been a huge emphasis on mega cap companies. And so, if we're going to look for any relative strength in small caps here in January, where is it going to be found? It's got to be found financials, industrials, healthcare, information technology. But financials is the largest allocation or the biggest percentage of the Russell 2000. This weighting is from IWM, which is the small cap ETF. And Blake, I mean, do you see financials really taking charge here early in 2025?
Well, I just asked the first question I'd ask is, did we fix the problem with Silicon Valley Bank?
No, we just kicked the
Because,
can.
yeah, nothing got fixed. So to bet on financials here, I think is reckless. I think is dangerous. We did not fix it. So the small caps cannot thrive while banks are not in a position to do so.
Yeah. And look, I mean, we're also Bill Ackman sent a tweet talking about the fact that Fannie and Freddie they're about to be unwound, right? In terms of the government's about to pull. It's going to take a couple years in that process, but what's going to happen with mortgage rates if you don't have Fannie and Freddie with that kind of that backing and their conservatorship with the government, if they're going to start to pull away and become separate entities, maybe even publicly traded companies, maybe there's an opportunity for those investors. But I think about the broader market and in the mortgage market, yes, we may have more market structure, but you're also removing potentially two companies that have originated most of the loans here since 2010,
Yeah.
like what, 90 plus percent.
Yeah,
So,
it's a
I
huge
mean,
amount.
yeah. So again, we got financials, we got small banks, et cetera. So as we think about the biggest risks for 2025, credit card debt is soaring at this stage. Revolving credit, we're basically at record levels right now in terms of credit card debt. Delinquencies in subprime credit card debt is significantly on the rise. We've not yet seen that for prime. So that's an area we could look for is our prime kind of credit card holders. And what would be an institution that could be holding on some of that? Like maybe an American
I was going to say
Express.
American Express is the easy one.
Yeah, so watch American Express. This starts to break. It may tell you something about prime credit card holders versus say like a Capital One Financial. What's in your wallet? Saw the gap, and now we're starting to kind of break down here. These have not performed quite as well. Discover Financial Services, these kind of banks here. We could look at Ally.
I was going to say Allied's pretty rough.
Has not done well. So we got the subprime space. So if you finance your furnace, probably went with Ally. So again, are you gonna still paying on your furnace? Are they gonna repossess it? Probably not. But we look at multifamily delinquency rates. Again, this is huge. This is Fannie and Freddie starting to see these delinquencies, and these are coming out of conservatorship, right? We're on the rise here, similar to what we saw back in 2008, 2009. And if you look at this is office, I'm talking about being commercial real estate here. We're back to 2011, 12 highs here in terms of delinquency rate. And who's holding the bag, Blake, on
Um,
commercial real estate?
well, frankly, like I said, shares held by a small bank. So we go back to the same discussion that didn't fix the bank problem. Small banks are holding the commercial. And the other one, which I didn't talk to you about before, would be the small regionals, but it's also going to be things like Blackstone.
Yeah.
And
So I'm
so
gonna do BX or BK?
BK.
BX.
Okay, that's
BX.
the right one.
So we got the breakout here, right? Lower high, consolidating, right? Or looking for another breakdown. This is kind of our, I'll just draw a little seed wave here off of the kind of this little seed down move right here. 261, 156. We could go back to lows again at 120. KRE, regional banks. Again, this would be a area to consider being bearish on, right? We're looking here
Mhm.
161 to 52, and we're looking down here 41. I mean, if banks start to really break down, this will help drag the market. We broke a gap level here. We closed the gap already. Now we're looking for a continued downside. And KRE did not start off the year well yesterday. And so, but again, you got real estate IYR. Again, very similar. It's a massive seed wave here. Again, 82 seems like a very easy level to reach here in the near term. And again, all that stuff does not really bode well for small cap. So again, I look at it's got to lead, but man, we got to really allay a lot of these financial concerns to be able to see small caps really move right now. And yeah, we saw some strength from technology yesterday. And Nvidia was up, semiconductors were generally higher. Um, Stocks like more undervalued semiconductor stocks like AMAT. Is there maybe an opportunity here? AMD, is there an opportunity here? Again, some of the laggards in this space, or do you just stay with your Carvana of the uh, of the semiconductor world, Nvidia? But if you saw some of these on Carvana, man, it's crazy. We've been on. I've been talking about this for a long time about how they made their money, and now we're starting to take a more scrutinizing look at how they did it, and it's not pretty.
Yeah, well, and it's for how long? So it's a big problem that's been building. So if this is the case, I'm not a doomsdayer by any stretch of the
No.
imagination because I'm talking about a 15% correction in equities, broad market equities. I'm talking about a pullback that is very tradable and sustainable to find our next opportunities. But the question for those of you that are more bullish driven, Brandon, is there a safe harbor? Because we're talking pretty bearish. I mean, I've got numbers on GDP to show that if we slow down any government spending at all, we're talking about a 10% negative 10% GDP number. And that could be a major crush of the economic situation, pushing us back into recession for sure, possibly depressionary levels. And that would be a real problem. But right now, I don't see that on the horizon. I see about a 15% correction. Is there a safe place for the bulls? Is there places and sectors that you see as a place and a play? I know you're looking at deep discounted stocks
Mhm.
just a second ago, but where do you see the safety from your perspective?
Well, so I'm looking at energy specifically, and again, I'm looking at uranium type stocks. I'm looking at oil related companies, integrated names like CVX. I'm looking for gold. Gold's not a sector, but again, I know you're looking at FCX as well
Hmm.
for materials. So I think there is some strength. Yes, there was a big role in materials to a 21 Feb 87.92 in XLB. So again, we're kind of taking this perspective. I mean, 92 is up here. We could see a rebound in materials, but I'm looking at gold leadership specifically. So like GDX or GLD, seeing that kind of leading out here. Had a great day yesterday. Bonds, utilities. So why utilities? I'm expecting some strength in bonds, which is going to help gold. It's going to help utilities. And again, just in general, dividend playing names, which again, you're essentially in a very similar place here with consumer staples and utilities.
Yeah, and the reason why I'd focus on that is because institutions, when they get wary and they step away from the banks, because they'll do the same, they're going to look for how do I get a return? They've got to still get a return.
Mhm.
Their goal is to get a return. And the institutions, the big players, the ones that control the majority of the money, are going to be looking for those safe areas. And by the way, there's this conversation that's going on. I've been watching these things where they're saying there's a huge amount of influx because we just passed a law that people are going to be auto subscribed to their 401ks. They're going to be participants. They're going to be forced in. For all the
Mm.
people that said, you have a 401k, here it is, and no one chose to do it. There's a huge percentage of the US employed workforce that have not chose to do that. Now they're going to be auto enrolled and they're going to automatically have money taken out of their account. So whether it's inconvenient or because they're worried about it, the fact is we are going to see an influx of capital, but it doesn't mean the economic or the equity market continues to go parabolic like it's done.
Mhm.
It means that we are going to see the institutions are going to say, we still need to get a return. We need an IRR, internal rate of return. We need a net result. We need to hit our goals. We need to get paid because they want to get paid. It's greed is good from Gordon Gekko, right? Greed is good and they're going to try to get paid, but they're going to be looking at secure ways to do it. And that's going to be in bonds and utilities. High dividend aristocrat type of stocks, that's where they're going to be. Now, energy, Brandon, I didn't include energy in mine, but energy is also a dividend payer.
Yeah.
And that's the thing is, I mean, so when you think about it, we have a situation where, I mean, look at the performance. This 12 week is a 1 year performance. I changed the script in here, but we'll sort. But when you look at what performed well in 2024, communications, but gold was the second best performer, right? In terms of its performance, this is all dollar driven, right? Which basically is all the performance you saw last year was all dollar driven. And you look down here in terms of materials was the worst performing sector, healthcare, real estate, energy. So kind of this consumer staples. Utilities actually did relatively well last year, but the idea is that the dogs of the Dow, meaning what performed worse last year, trading at better relative valuations. And I'm expecting energy prices to hold up. And my basis in that is looking at current inventory levels. They're very, very low. Again, there's been some agreements in terms of maybe we're going to start to export more. If we look at production, we're at record highs right now in terms of domestic production. I do expect that to continue to rise. But again, we're probably going to export more and we're very undersupplied. And this does not reflect, I don't think this reflect the SPR at all. And so strategic petroleum reserve. So again, we have very, very low inventory. So I think the risk is the upside in oil. And if we look at the Fed expectations for, I can close that out for, well, let me do it. Oh, well, we'll go out to December. What's the rate cut range? We're looking at what, 3.75 to 4%. So we got two rate cuts for next year. Again, that's not a lot of support, and that could be pushed off if oil prices hold up and begin to rally. And what we may see is 2025, we could see a resurgence in energy profits, which may allow this to move up the list. But the risk for energy is a recession. So, and that helps staples, that helps utilities if we start to feel those recessionary pressures. And it helps gold to some degree, but if the dollar strengthens, gold will go down.
And that's why yesterday even I talked about basic materials, but only picking the ones that are already stable. So that's why FCX made my list, right? So FCX is way down here at the low, and you say, Blake, why would you put that on your list? Because it can't go any lower. Wait.
Right. Original thinking, right? I mean,
That's right.
this
It
time
can't
it's
go any
different.
lower. This
We
time
got
is
two
different.
24% advances in the market for 2 years in a row because of weak dollar. We didn't even, most sectors didn't even outperform gold. And we're going to get to another 20% this year. Eh, it's
Yeah,
original thinking here. But 1.5% yield on it. Yeah, this is a stock it's trading at a very significant value here. And again,
yeah.
if copper goes up, gold goes up, this stock will hold up.
Well, and those that didn't watch my video didn't see me discuss this, but here's the thing. Look at this chart for just half a second, then we'll go on to the other ones. But FCX is at this key support level. It is a support level that was for the last year. You can see that it has pushed little shadows below. But here's the catch. You can get paid almost 4% for 1 month short put. What
Ooh.
that means is being told, I will pay you enough premium that if you're willing to buy it down here, I will give you 4%. And as we're looking at that premium, and I was using the 38s for the even for that point for at the money. So you're saying
Are
that
you 7 Feb or
I think it was yeah, it should have been 7 Feb yesterday. Yeah. Anyway, so we're getting paid. It was getting paid 3.5 to 4% on all these ones that I looked at. And so we're getting paid that percentage. Now that one is 219 where you're at. And our spread's pretty wide. We'll have to see how it opens.
right,
Because I was looking at it yesterday when the market was
right
open.
when market's open?
So if we get paid 4%, what that says is the FCX can drop 4% and you lose nothing.
Mhm.
What it's saying is that if it doesn't move, you get paid 4% for a single month. And as a safety play at a very deep discounted area, if you think that gold is going to maintain, if you think that copper is going to stabilize, because they do copper as well, if you think they're going to stabilize at these lows, you're getting paid 4% for a month. And it's not really high current implied volatility. It's just saying this is discounted enough. They're going to pay you 4% because people are buying insurance on this. And so I think it gives you that extra safety net. If it doesn't move, if it just holds like it did for 2 months, why not get paid 4 to 8% on this?
I mean, so when we look at implied volatility, let's just back this out. Let's say, 3 or weekly. I mean, volatility, I mean, it looks relatively low, but we're comparing to last year. I mean, volatility has been, we go back 2023, we were lower, much lower than we were currently today. We've had periods where we've had higher volatility, but this is probably more of a moderate level rather than a lower level, just given the fact you go back in the past and we've had periods of lower volatility than this for long periods of time. So it's not a bad amount of premium for FCX. Um, so as we kind of look at our bulls and bears here, again, Rio, FCX, we got, gold play. I've got
Mhm.
Barrick Gold on here, Coke, CVX. I really like CVX. We did this before, but CVX at this level, you get a 4%, over a 4% yield on it. We're at a key support level down here at about 138. We kind of did this back here with a target of 165. Yeah, I talked about it down here again, but looking at 165 as a target, and you get that 4% yield if it does nothing, right? You could even
Yeah.
use that dividend, which they paid back here in November. So we got a dividend coming up here in a month or so, but you can use that $1.63. You can even come in and buy a put for 21 Feb. What can you get for a buck 63? Come out of pocket a little bit. You buy a 140 put. You've got $6 of risk, a little bit more because you got the additional cost in, but not much. That'll allow you to hold through the next dividend payment. 140 is right here. So you got a guaranteed stop at 140. You got a target of 165. And so again, I'm looking for integrated names to do relatively well.
And I love that it protected stance when you can get the dividend to pay for your insurance, your put insurance. So on the
Exactly what we
opposite
did
side,
here.
yeah, you buy the stock, you buy the put with the upcoming dividends, knowing that you're protected and you can't have any bigger loss. And I know that some of you would get nervous about short puts because it is a naked position. But remember, you're at no greater risk with a short put than you are buying the stock without doing what Brandon was just showing you. So either you do something like Brandon's showing you that you can protect yourself and have a guaranteed protection with that long put, or you sell the put and it's no different than if you bought the stock. A gap
Yeah,
is a gap and you're still exposed.
right. So a short put is a synthetic cover call, right?
Mhm.
It's just you're basically doing it in the money here. Like it's like you're selling it in the money cover call against it. You get your long stock in effect because you're long below the strike price. Yeah, so you can look for a better probability return. Or you can say, look, I got $7 of risk. I've got upside of close to $20. We did this back here on the breakout, 10% upside. We had a stop at one. We bought a put at 145. Again, limited risk, very good risk reward in this too. So either direction works for CVX. Barrick Gold is one. We're starting to see it come off lows down here. Again, we just kind of broke out yesterday. Not a lot of volume behind it, but again, we could readily see a decent retracement of this downtrend and 17, $19, break 19, expect to a 21. I think we're about OT here, but
Yeah,
Blake,
we are.
on the bearish side, what do you think about China here, FXI?
I just don't think, I think if we're slowing down, if we see lower spending, if we see that effect kick in as whether we're talking about the Buffett indicator or government spending or the Department of Government Efficiency slowly are spending. The fact is the economy slows, the world slows, and FXI takes it on the chin.
Now, again, they're trying to stimulate, and again, that is if they were able to see anything happen in their economy, it does help oil.
Hmm.
But again, they were at five x times our real estate market. They're now 2x. Again, is China's economy able to support that? I'm not sure our economy is able to support our current real estate prices. They're certainly not in that position. Again, centrally planned economies do not work. So I'm not a bull, but we're going to see little pockets of strength in FXI. And I was able to play. We did be able to do
Hmm.
trades on FXI or KWeb and a couple of times last year off the lows
Yeah,
here, and then we caught this move there. So we'll watch for
which is
strength,
which is
but
great. I'm just
I'm
talking
not
about I'm
expecting
talking about
FXI to go up.
2025. I'm talking about the
Yeah,
whole year. If we
right.
hit economic slowdown, we're not. This is not a sell for me. It's just
Yeah.
watch this key level. If we
This is
break
not
free,
this is not
economically
Wesley
fall.
Snipes and Passenger 57, right? I'm like, this is Xi Jinping, right? And the PBOC. You cannot count on
Yep.
them to produce anything. So, all
Yeah.
right.
Well,
Well,
it's a big year. It's going to be huge, I think.
it's gonna be big.
It's going to be a big year, and we've got a lot of things. I'm not betting on the ones that have already gone too far too fast. I'm just looking for those that are going to be the safest, cleanest, and best opportunities where we can protect the accounts, we can protect the principal. Because even if we don't go into a pullback or don't go into a recession, there's still going to be some reshuffling. And I just don't see that we can sustain a 70% of the value going into the mega cap. And so watch for some readjustments, but buy the discounts. Your opportunity
We're
is
just
safer
playing the
that way.
probabilities, right? Risk
Yep.
and reward probabilities where we're at. You expect to see some rotation of value. So,
Yep.
all right. Well, Blake, we got to
Absolutely.
wrap it up here. We got to pass
Okay.
it on.
All right. Have a wonderful day, everybody. We'll see some of you in the main room here shortly. Brandon, thank you. And thanks everybody for joining.
See you, Blake. See you, everyone. Thanks for joining us.